real estate transaction to help you pass your real estate exam. If you're in the 14th edition of the Dearborn book, it would be Unit 21. So closing the real estate transaction. The closing is a conclusion of the real estate transaction. It's a conclusion, okay? Title is transferred in exchange for payment at the closing. We all want to have closings. The more closings you have, the more paydays you have. That's when you get paid at the closing. And that's when the seller and the seller conveys the title and the buyer gives him compensation for that. And negotiations may continue until the last minute. And sometimes they do. Sometimes we're negotiating at the closing table. Sometimes we do a final walkthrough and the buyer's not happy with the condition of the house. And we're negotiating right down to the last minute to try to consummate the transaction. Okay. And closing is a culmination of many, many efforts. Okay. The buyer wants to be assured that the seller is getting good marketable title. How does he do that? How's the buyer ensured that he's getting marketable title? What's that?
Title policy.
Title policy. Okay. The buyer wants to make sure that the property is in its promised condition. The same condition he's seen it at, Christine, when he made the offer. Okay. Sometimes do you think the condition changes? Yeah. Do you think sometimes the seller takes fixtures that he's not supposed to? Or bangs up the wall when the movers are leaving? So the buyer wants to make sure it's in acceptable condition. The buyer wants to look at the deed to make sure he's getting the right type of deed. General warranty, special warranty, right? Any documents, a survey sometimes. So these are all things that the buyer may be looking at the closing table. Any leases. If there's a lease, the seller wants to give that lease now to the buyer, because now that buyer is responsible for that lease. And again, a final walkthrough to verify the physical condition. So those are things that the buyer wants to make sure. Aren't they just common sense things, Seneca? This is an easy unit. The seller wants to be assured that they're receiving payment for the property, right? They want to make sure they're getting payment. And that the buyer has obtained funds to complete the sale. You don't think sometimes a buyer comes to the closing and ain't got enough money? Yeah. So the seller wants to make sure he got enough money. Both parties must be satisfied that everything's in order, that the exchange is made, and the documents are then recorded in the courthouse in the correct order. Okay. So this is closing the transaction. This is what it's all about, Christine. Okay, this is what you're working towards. Okay. In Pennsylvania, the buyer is responsible to determine whether title is good or not. So it's not the seller's, Seneca's, responsibility to prove that the title is good. It's the buyer's responsibility to do a title search and to make sure he's getting good title. Okay. And you do that with an abstract of title, typically a title commitment from the title company, and the seller may sign an affidavit of title stating that there's no other defects to the title that he's aware of. So a lot of times the sellers will sign an affidavit that there's no other liens or judgments against the property. Why would we want the seller to sign that, Tam?
Is verification that there's nothing there.
Yeah. So let's say they do a title search. Title search is usually done about a week before closing. Okay. And the title looks good. The only thing on the title is the first mortgage through PNC Bank. And let's say the seller, day before closing, goes to commercial bank and gets a home equity loan. Well, the title insurance ain't gonna pick up on that, right? Because the title insurance is done. So the seller's gonna sign an affidavit that there's no other liens. He didn't put any other liens on it. Okay. Typically, the closing here in Pennsylvania is face to face. They come into our conference room, the sellers are on one side of the table, the buyers are on the other. Okay. Who can come to the closing? Sometimes the buyer, the seller, sometimes their attorney, sometimes the licensees, the lenders, the title company, the closing agent. All these people can come if they want to. Okay. So if the buyer says, I want my attorney to come to closing, then he can come. If the seller says, I want my attorney, the title agent, he's the guy that's issuing the title insurance policy, right? In our case, we use Penbridge a lot. So Penbridge would be the title agency. They're going to issue the insurance, but what's the young lady's name that comes to our office and closes all the time?
Paula.
Paula? Mm-hmm. Paula is the closing agent. So she's just a closing agent. She just comes and sits down and gets everybody to sign the paperwork. Make sense? The IRS requires a 1099 be sent in on the sale or exchange. The exemptions would be residential transactions where it's the primary residence for 2 out of the last 5 years. And I think if you look in the book, it could be if you're married up to maybe 500,000. What's the exception? Does it say in there? The IRS requirements? Let's look at that. Right here, IRS reporting on page 418. They don't get into the amount, but just know that the title company would be responsible to send the seller a 1099 if there's any, if it would be like an investment property or so forth. Regular residential, there's a certain limit. As long as it's under that limit, you don't have to pay any income tax. So that's nice, Jace. You buy a house, you live in that house for 2 out of 5 years, you paid $150 for it. In this market, now it's worth $225. 3 years later, you go to sell it, you don't have to pay capital gains tax on that investment. But if it's an investment property, you would have to pay capital gains tax on it.
But if it's your personal property, you don't.
If it's your personal property that you live in, there's certain guidelines where you don't have to. They don't go into them here, so I wouldn't get all caught up with that. There's cybersecurity issues with closing. Sometimes the buyer doesn't bring a check to closing. Sometimes the buyer wires the funds to the closing agent. And this is a good way for cybersecurity hackers to get involved, because let's say that you're the buyer, Laura, and you're not coming to closing, or you're wiring the funds for whatever reason. And then you get an email, and let's say the closing company is ABC Closing Company. And then you get an email day before closing says, don't wire them here, wire them here. And then you wire those funds where the email tells you to wire it. Looks like a legit email, right? And then you find out when you go to closing that the closing company never got your money. Somebody hacked somebody's email, the real estate agent's email. And they know who's involved in the transaction. And then they sent this buyer an email right before closing saying, wire the funds here. So I tell my buyers, never go by an email. You need to call the closing company up and talk to the closing company and let them give you the wiring instructions. And no matter who sends you an email after that. Can we do a slide for Monday's meeting on that, Andrea?
On what? Sorry,
on cybersecurity issues with wire fraud,
Okay.
with closings.
I like we've done that before.
We have. You may be able to find it. It's a big thing. So as an agent, so hear what I'm saying? Just talking about it, I'm saying, oh, maybe it's something I better talk to my group about and reinforce that they need to talk to their buyers and tell their buyers, never wire funds to somebody that sends you an email. Always call the closing company and get the wiring instructions. Does that make sense, Jace? Yeah. I mean, somebody could be out hundreds of thousands of dollars. The email could even come from you. Hey, last minute change, email the funds here. Federal laws that impact closings. Real Estate Settlement Procedure Act, RESPA. It requires certain disclosures. It applies to first liens made to finance 1 to 4 family dwellings, homes, condos, and co-ops. It does not apply to large properties more than 25 acres, commercial, vacant, or agricultural land. So RESPA. Here's that single family 1 to 4 again, huh? It doesn't seem like the government, Ellen's trying to protect people that are buying 1 to 4 unit dwellings, the average consumer, right? Effective 2016, you have to have a good faith estimate and a uniform settlement statement, HUD-1. They have been consolidated. So it used to be you had an estimate and a HUD-1. Now they have what they call a TIL, and it's a one document. The new TIL. What page is that on? Where they talk about the TIL? Page 422. The TIL, and then it's the TRID rule. As part of the Dodd-Frank Wall Street reform in 2008, when the market crashed, and the Consumer Protection Act, the rulemaking responsibility for the Truth in Lending Act, TIL, and the Real Estate Settlement Procedure Act, RESPA, was moved from HUD to the Consumer Financial Protection Bureau. The change is intended to make it easier for real estate borrowers to understand their loan and settlement costs. So let's see if we can get.
Thank you for calling Hannah.
Hey, Laura, is Sydney available? Hey, Sid. Hey, I got you on speakerphone. I forgot to bring that speaker in. Everybody's in the class. Say hi to Cindy, everybody.
Hello.
So in 2016, they came out with a new TIL. Is that correct? At the closing? Okay. So is there 2 documents that the buyer gets at closing, or just one?
Well, there's the closing disclosure and there's the ALTA.
Okay.
The ALTA is supposed to be separate. The buyer has their side and the seller has their side. The closing disclosure has the whole thing wrapped up in one.
Okay. And they call that the TILA, the TIL?
Yeah, Truth in Lending.
And that's the closing disclosure that has both of them.
Yes.
Okay. So the buyer gets a disclosure. They call that what?
The ALTA.
The ALTA.
Yeah.
The seller gets an ALTA. And then there's a disclosure that has the whole transaction, and that's the TIL.
Correct.
Okay. Okay, perfect. Thank you.
All right, Tom.
Thank you, Sin. Bye-bye.
Yep.
So, of course, it used to be you just got a HUD-1 settlement statement. The government made it even more complicated to make it easy for people. So, RESPA prohibits certain practices, kickbacks and referral fees. Okay, you can't get a kickback from the mortgage guy. You can't get a kickback from the insurance guy. You can't get a kickback from the title guy. Okay, and it prohibits requiring RESPA. This is RESPA. Prohibits requiring that the buyer use a specific title company. The buyer has to have a choice. It prohibits excessive escrow amounts. And enforcement is from the Consumer Financial Protection Agency. Ellen, would you be kind enough to pass one of these out to everybody?
Yes, that's what I needed. Sounds like an emergency thing. Yeah. It's a bad file.
Okay, so Ellen was nice enough to pass out affiliated business arrangements. So real estate companies can have an affiliated business relationship with lenders and with title companies, but it has to be disclosed. So this is one example of one that's been that this company uses, that they disclose that there is a relationship with the lender or with the title company, and these are typically the fees, and you're free to use whoever you want to use. Okay? So if there is an affiliated business arrangement, you have to disclose it so that the consumer knows. So the TIL and RESPA integrated disclosure, the TRID rule, it's a little bit complicated. I would just know that it's a rulemaking responsibility for the TIL, TILA, and RESPA has been moved from HUD to the Financial Consumer Protection Agency. I would know that. And they call it the TIL RESPA integrated disclosure. were moved from HUD to the Consumer Financial Protection Bureau. Changes are intended to make it easier for borrowers to understand their loan and settlement costs. Changes apply to federally related loans made to the majority of home buyers. It does not apply to home equity loans, lines of credit, reverse mortgages. Okay? If the loan is sold, the first lender must include the closing disclosure in the transfer of the loan file. The lender must keep these records for 5 years. So let's see if we can get this video working.
We're a community of over 19,000 doctors. We've practiced at all top 20 U.S. hospitals. October 3rd, 2015. TRID becomes mandatory and changes the real estate closing process as we know it. So what should buyers, also known as borrowers, that fall within TRID expect when buying a home? All borrowers that fall within TRID guidelines will receive the LE, the loan estimate. This form outlines the estimation of fees for closing. Lenders are required to give accurate fees, and this form must be provided to borrowers within 3 days of applying for a loan. For closing, borrowers receive the CD, the closing disclosure. The closing disclosure must be provided to borrowers at least 3 business days before closing. And yes, Saturdays are considered business days. Failure to deliver the CD at least 3 business days before closing will result in a delay of closing. So why the new forms? Pre-TRID buyers would meet with a lender to apply for a loan. The lender would ask, so if you had your dream job, how much would you make? Or, Mr. and Mrs. Borrower, just breathe into this mirror for me. Have you seen the movie The Big Short? Now, to be fair, not all lenders were doing shady deals. There were and still are plenty of great mortgage providers to work with. But that is a conversation for another day. Out of the 2008 mortgage crisis, the president signed the Dodd-Frank Act into federal law on July 21st, 2010. And on July 21st, 2011, the CFPB was formed, the Consumer Financial Protection Bureau.
So that's who
the
controls
CFPB is an independent
right
agency of the United States government responsible for consumer protection in the financial sector. The Bureau is charged with enforcing the laws within the mortgage industry. Consumers who feel they have been mistreated can voice their complaints directly to the CFPB. The CFPB can fine violators up to $1 million per day per violation. So we have talked about the forms and the how and why the CFPB was created. But what does the closing process look like for borrowers that fall under TRID? Most of the changes have to do with mortgage lenders. When borrowers work with lenders, there are a lot of forms to sign. No, more forms than that. Getting close? There we go. How about with attorneys at closing? You see, previously the buyers and the sellers would meet at the attorney's office at the same time to sign documents. Now, while the sellers sign documents, the buyers can still be in the room, but when the borrowers sign, the sellers can't be in the room. The reason is because the seller cannot see the private loan information on the buyer's closing disclosure. Remember, the CFPB is called the Consumer Financial Protection Bureau. The buyer is the consumer. So most of the rules are aimed at protecting the buyer. You might be thinking, well, are all buyers subject to TRID? Great question. The answer is no. Here are the types of borrowers that are not subject to TRID. Borrowers seeking a home equity line of credit, also known as HELOCs, those looking to obtain a reverse mortgage, those obtaining a mortgage secured by a mobile home or dwelling not attached to land, borrowers who are seeking a no-interest second mortgage made for down payment assistance, energy efficiency, or foreclosure avoidance, and the last, but certainly not the least, those getting a loan from a creditor who makes 5 or fewer mortgages in a single year. All of these types of borrowers, as well as cash buyers, will receive the HUD-1 settlement statement at closing rather than the closing disclosure. So what kind of buyers does TRID apply to? All closed-end consumer mortgage loans secured by real property purchased primarily for personal, family, or household purposes, including construction loans, vacant land loans, 25 acres or more loans, or single-family residence loans. There you have it, TRID, the Truth in Lending Act, Real Estate Settlement Procedure Act, Integrated Disclosure Rule.
Does that help a little bit, Ray? Does it? So, again, we talked a little bit about the TRID and the TILA, that's the Truth in Lending Act / RESPA Integrated Disclosure, the TRID rule, okay? We talked about the loan estimate has to be given 3 days after the borrower makes mortgage application. So don't you think, Lauren, that the borrower would want to know all his true costs to finance? So you have 3 days to give that to them, okay? 3 business days, and Saturdays are included business days, right, Christine? After the loan application is taken. The closing disclosure, or the CD, is given at the closing. We talked about that in here. No changes to the closing disclosure table except, so the closing disclosure has to be given 3 days prior to the consumer, 3 days prior to the consumer closing this transaction. See what they're trying to do here, Jace? If you go get the loan, you have to get the estimate 3 days after you make application, right? No longer in 3 days after, so that you know what's going on. Then the closing disclosure, the final figures have to be given to you 3 days prior to signing on a dotted line. And you can't make any changes to the closing disclosure except for unexpected discoveries during the walkthrough, changes made to payments at closing, real estate commission, taxes, utility, probation amounts, or escrow can be in the closing, can be made. Other than that, you can't. So let's talk about preparation of the closing disclosure. And the closing disclosure is given when?
3 days prior.
3 days prior to. Has the debits and the credits, the broker's commission, attorney fees, recording expenses, real estate transfer tax, title expenses. Okay, so the closing disclosure is 100% breakdown of all the cost rate in the transaction. Title insurance rates in Pennsylvania are set by the state. You can get a reduced rate for previously issued title insurance. So let's say Ellen has title insurance on her house. She sells it to Vaughnie. Vaughnie says to Ellen, hey, man, you got title insurance? She says, yeah. Vaughnie goes now to get her title insurance. She can get a reduced rate because if she can get a copy of Ellen's policy, because they're gonna look at that and say, well, shit, we don't have to do all the work because we already have a title insurance policy that was issued for you when you bought it. So they ain't got to go back to William Penn. They only got to go back to when Ellen bought the property. Does that make sense? Loan fees will be on there. Tax and insurance reserves will be on that closing disclosure. if they're escrowing for taxes and insurance, appraisal fees, survey fees, other fees, any accounting expenses. So it's a complete breakdown of all the cost involved is that closing disclosure. And that consumer has to get that closing disclosure 3 days prior to settlement. Now, the loan estimate, when does that have to be given?
3 days.
No more than 3 days after the consumer makes a mortgage application. Okay? We're rolling along pretty good here today. So let's talk about prorated items. There's accrued items. These are expenses to be prorated that are owned by the seller, but will be later paid by the buyer. Okay? So for example, if you sold a house today, okay, if you sold a house today, this is February 15th, and we closed on it. We closed on it. The county and township taxes are going to be coming out like right now. Okay? But if we close today and the county and township tax hasn't came out yet, Garrett, the seller is going to be responsible from January 1st till today. So they're going to get that tax bill and they're going to charge the seller for those expenses even though they haven't came out yet. Those are accrued items. Okay. Can you see how that can happen? Because the taxes, the county and township in this area are prorated on a calendar year basis. But does anybody here have a house? When's your tax bill? Your county township taxes come. They come right about now. So if you close before that tax bill, you know you owe it. So those would be put on the closing disclosure. Those would be put. And then there's prepaid items. So if the seller prepaid for the garbage all year long, okay, and we're closing today, the buyer then would have to reimburse him from February 15th to December 31st. Okay. So either they're going to be accrued if the bill hasn't came out yet, but the sellers are responsible, or prepaid where the seller already paid him and he's going to get reimbursed. Okay. Rules for proration. Ownership on closing day. The seller owns the property on closing day. So if we were going to prorate those taxes and we were closing today, and the taxes are prorated on a calendar year basis, the seller would be responsible from January 1 to February 15th. Okay.
Oh, that's so hard to figure out.
Yeah.
There's questions like that.
They do have some questions like that.
I always guess C. Yeah, I don't know.
So in Pennsylvania, the seller owns the property on closing day. Special assessments may be assumed. So maybe if there's a special assessment, we need to prorate that. Rents may need to be adjusted. Security deposits may need to be given. So if I was selling an investment property, Christine, and I collected the rent on February 1st, right, for the whole month of February, and I sold the property today, the buyer is going to say, well, I want that rent prorated because I want my share from tomorrow till the end of the month. Does that make sense? Okay, any questions on that one? That's a nice, easy, breezy chapter. We only got one more chapter to go, man. One more chapter.